Brotech. First things first. I noticed that we were talking about you're talking about the Netflix Condor that you were trying to get filled in. So let's dive into this and see what we got. Okay. Let's do this. Okay. First things first. You've got earnings, which is coming up on the 15th of October. So whatever Condor, it would have to be something that you're out of before the 15th, because that's when the volatility. I'd actually say the 14th, because the volatility will start to increase as it goes into earnings. So you might even want to get out sometime in September. You'll start seeing volatility tend to increase. Not saying that that of course anything's possible. This could be different. If we look at the fundamentals with all these other streaming services coming in, we're seeing why Netflix is imploding. Because everybody's coming in making their own Netflix, and that's why I can't go without seeing a YouTube video without a Netflix. You can get it, watch all you want for $6 type of ad. So, I'm not saying there's more downside, but it could easily get down to the 234 mark. Not like it will, but it easily can. And that's way down at this area right here. It could get there. If you look at the fact that it got from 335 to 291, it could easily get down in that area, and it wouldn't take long. The only good thing about it is you have this gap right here, which more than likely will want to get filled before it starts heading down. Not saying it will. Anything can happen, and I haven't put my geometry in it yet, but let's go ahead and check out a few other things. You've got volatility, and this is what I like to look at in terms of volatility. If I go a year, the highest high and the lowest low from a year back, and I could say, let's see, what would that be? August of 2017, or 2018. Let's see if I can go back. 8/27. Okay, so this would be of 2018. Okay, good. So I do have this. Hold on, because okay, there we go. 2018, the highest. And what I do is I like to see where the volatility is sitting in terms of, so that's August, the lowest low, the highest high, boom. Then we have, if it's over this line right here, the 50% line, then I start looking at doing condors. It's not, so, you might have a little, it might get a little scary trying to put a condor on. I hope, did I go back too far? Because I may have gone back too far. Hold on. No, that's 2018. So 7/2018, right, of August. 2019 of August. So yeah, okay, so that's the last year. It's still underneath the 50% point of volatility. Now I could, if I'm going for something a shorter time for a condor, I may take it the last 6 months. Got 1, 2, 3, oops. 1, 3, 4, 5. Let's see, that's March 6th. So let's say about March, somewhere around March. The lowest low and the highest high. This would be the highest high, and that would be the lowest low. So it's still, even in the last 6 months, it's barely, so you might not get a lot of premium for it, because, the volatility is not really, a lot of premium. But, if you're going for just a month, you might get lucky and get a little bit out of it. I would wish that there was more premium there. Also, I like to look at the VIX and see what it is. And if I look at the VIX, this is kind of like an overall pair. It's telling, kind of the stocks are inexpensive or expensive. Where's the premium on like if it's really low, then there's not really a lot of premium down in this area. It has spiked up
but these are, again, are just spikes. Notice how these over here are very, long points of where the lows, where it stayed at the lows. That meant that's very cheap right there. Notice as it elevated up here and it kind of stayed relatively up there, but these spikes I don't put into complete consideration unless I'm doing a really short-term time trade. So as the VIX ranges in that area, it's looking like it's starting to set up for, continue to go up, or stay in this range right here, in this area. If it could stay in that area for a minute, and let me show you the area so it's a lot more logical, then we're looking at, where the premium is starting to build, and you might have some good times to where, because you want to go ahead and set up condors when you get at least a little bit of an area. If you could get a little bit more, just a tiny little bit more building of the cost of premium with the VIX, then what happens is after a while, when it starts to bleed out, or when you start getting rid of that premium, that's when your condors are really, really nice. And then if we look at, but again, if it's super short term, like a week or two, you can, instead of going 6 months, in terms of how far back the low to the high of volatility. Now looking at the premium over here, the implied volatility is pretty high. So oh, well, options are expiring. That's, there's a lot of, it's pretty high implied. I've seen a lot more expected moves, on a, oh no, I'm sorry, I'm on the VIX. I was looking at Netflix. That's why. I was looking at more expected moves. That's why the volatility was implied. Now it makes sense. Yeah. See the implieds over here? The implied volatility of Netflix, and these are the expected moves. These are telling you that right over here how far this thing can move. $15, whatever. This is telling you. And if you were to do like a September condor and you want to get out by September, you're looking at a $23 move, 39% implied volatility. How about after that? What's the implieds after that? After that 39. Okay, so it's going down 38. Okay, and they're expecting it to go down before earnings, and then of course the earnings, you get that 44%. That that extreme move. They're saying at earnings, that's when you're going to get that monstrous move wherever it goes. But a lot of times, a lot of folks will build calendars, and then they'll build the calendar right before. Or no, so they're buying volatility and then selling volatility, like with a condor or whatnot, that the earnings. So if it's far enough out, it won't hit the condor walls. And so, I've seen that a lot. Basically buying and selling volatility. So yeah, so you got a $23 move that this thing can get to $23 either way. You could go either that way, $23 away from the price, up or down, if you're trying to put it on now. Or you could do the probability of touch, which tells you, or the delta, for lack of a better term, which what's the probability that this market will get down into your that it'll touch your strikes. What's the probability it'll touch that short strike? And of course, the improbability of touches, you can get down here where it's like, okay, a 21% or a 39% chance it'll hit my short strike. Not close on there, but just hit your short strike. And that's good for when you're taking on heat and you're like, oh my God, it's getting too close to my short strike. At least you got a probability of what the highest probability it would be in terms of or the 68% chance it'll hit it'll tag your short strike. So that way, you can breathe a little easier. I'm just looking at the E-minis and seeing how the E-minis are setting up for tomorrow. Now, so if we were to go, let's go 291 minus or plus 23. So 268 We'll go 265, and that's got a 42%. Wait, no, not 42%. It's got a 39% probability of touch. The 39% that, there's a chance on the 265 strike, where your first short strike is, that, that you could possibly, that the market might touch that strike. So the 265, and then I'm kind of tired because I ate a gang load of homemade tortilla, gang load of tortilla chips and everything else. I just scarfed like crazy. So major workout today. And then 314. So the 265, 315. And what is the 315? The probabilities that you'll get touched on this one is 34%. So it's more of a probability on the downside than the top side. But if you were to do a condor and wanted to use the probability of touch, either way, you could use that, or you could use the expected move, which is basically the same thing that I just did. I use the expected move to get to see the probability of touch. But if 38 or 39% is too much for you, and you want it to only have like a 20% probability of touch, it'll be way outside your expected moves. So, your expected move would be a lot better in terms, because there's a chance it will never, ever get down. If you got like a 20% expected move, it's saying, there's a chance that thing will never get down there. Yeah. So, and 315. So we've got.
Let's go to 315 first. That's the top string. And selling the 315. And we'll get to where we're buying. And then I'm selling the 265.
Oops. I must really be tired. Okay. Now I want to see how much premium I can get on this. Okay. Now the 315, if I go $5 up, the 320, and 265 to 260. Now a standard rule, which is, I gotta thank the what's the name guys, the Tasty Trade guys in this. Now let's take this date and move this date to September. Or actually, we could do it here. This is where we want to do it. September. Okay. So yeah, we're slightly inside these expected moves, the gray area right there. But it gives you kind of an idea of and delta wise, we're a little bit short deltas, which means that it would challenge us on the upside than it would challenge us on the downside. As you could tell, how this is where the market is, and this part is wider than this part. We have a little bit more room on here. It would challenge us on the upside, before it would challenge us on the downside, because we're a little bit more short deltas. So we're a little bit more short on this. So anyways, the strikes are $5. If you could get a width of the 1/3 the width of the strikes, which is kind of standard rule, 1/3 the width of the strikes, which would be 166. You're not getting that with a 145 credit. So the thing is there's ways of doing it, but you could either move the strikes together, or you can wait till the volatility increases, if it does, or you could if you make you could move the strikes apart and make the strikes a lot less, but again, no, actually you wouldn't be. You'd make the strikes more, actually, bigger. But chances are it's because options are very efficient. You probably wouldn't get that. If we made the strikes instead of $5 apart, or you can settle with 145 and just try to get 50% of it instead of a third, because you're looking to try to get like trying to get 166 out of this is what you're looking for. If you could get that, cool. That's kind of the kind of a standard kind of thing. And I'm gonna go into the other account as well, my Tastyworks account, and into my interactive brokers, and just see what their analogy on the probability of making 50%. So if you know that you're getting that credit of 145, if you can get, what is that, 76, about 76.50 out of it. If you can get 70, is that 76 or 66.50? Let's see, 145. I think it's 66.50. My bad. 145 divided by 2. 72.50. Where am I at, man? I'm telling you, them burritos got me. I'm thinking. See, you see how tired I am. I'm dyslexic. Anyways, no, but those burritos. I mean, I made these bean things, and I have the actual recipe of the salsa especial from Trader Joe's. So I never go there to buy it again because I make my own, and it's exactly the same thing. Save yourself, like $50 a pound. But anyways. If you can make $72 on this kind of a trade, then it's not a lot, but you want to get that 145 credit is what you want, and you'll make that 50%. Okay, it's without a doubt you will definitely grab that 50%. The only problem is you're not getting the amount of premium. So if I went ahead and lowered these strikes and said, if I made them 250 instead of that, let's see if, yep, so it's being traded. 250 and 265 to 2, so it'd be 260, 250. Oh, it's not traded. Okay. So let's go 263. We'll make them $3 strikes. Oops, not traded. Okay, so it's not traded. So yeah, you'll be getting. So we'll stick with the original plan. It's not granular enough for you to make money on to see if it's going to trade. So anyways, if you're satisfied with the premium minus commissions, hopefully you rescheduled your commissions with your broker, because I would not do this unless your broker gives you a major deal in commissions. Like this trade would cost me a little less than $4 on my other platform. Okay, and on the other platform it would only, and I'm talking $4 total on the other platform, in and out with all legs. That's what it would charge me less than $4 on all this to get in and out. And I'm talking to this Thinkorswim to let them know I want to readjust my commissions with them, because I get so much better commissions. Some folks would have to pay, and I did back in a while back. This kind of a trade would cost me when I first started, it was probably $7 a leg. So it's damn near $50 to do this kind of a trade, which cuts into that 145 credit. I mean, that was a while back. But anyways, if you're looking at that, you want to get at least a third the width of the strikes for your profit. Okay. A lot of times making 50% of your profit, you could do that and get out, and of course, as it gets closer and closer to earnings, the volatility will most likely rise, depending on how crazy, God knows what will happen with Trump. And as volatility rises, it's good that you have a little bit more room on the downside, because usually when volatility rises, the downside gets attacked more than the upside. So you have a little bit more room, expected move, as well as probability of touch. But the thing that would hurt you is if volatility fell. If volatility falls, and all things being equal and the price doesn't move, let me put this other platform up. All things being equal, volatility rises. And say we get a rise in 5% volatility. Not like it would, that's kind of extreme. Notice what it does to your trade. This is your T+0 line or what you're going to get paid. Not at expiration, but what you get paid, daily. If volatility rises by 5%, you're going to get screwed. If it falls by 5%, look at that. You're making money. And you could tell by where the price is right now, you would be making $31 as opposed to losing it if volatility fell. Oops. Volatility falls, you'd be losing, what, about $20? About almost $30, $27. So it's kind of like, it's one of those things where, like if volatility starts rising, it's gonna diminish the advantages of putting on a condor. And of course, volatility, if it starts to fall, then your price will start to go up, which might pose a significant problem because this is kind of within that expected range. If we move this out to the expected move, it would be way out of the probability of touch. But the problem is, and remember, the probability of touch is more likely because of the fact where the volatility is at. The chances is if you moved it out there, you get a lot less premium, a gang load less. Like right now, the premium you would be getting on this is 145. If we move this out to the 320, 325 strikes, which is where that is at, 320, 325 strikes, then you'd be getting significant less. You're getting 129, not including commissions. Now, there's another thing you could do, and that is you can actually, instead of making them $5 wide, 315, you can make them $10 wide. So we'll go and sell, the 315, 325. 265, 255. Wait, 265, 255, not 235. My eyes are shot, so. Now, you're getting 261, but that's a $10 wide strike. So, if you're going to do a $10 wide strike, 10 divided by 3, you'd have to get about $333. So you're still not getting the premium for the amount of risk. And again, the same challenges with volatility are the same. And everything else, all things being equal. The strike. So a safer trade to not tie up a lot of money, of course, with the same objective would be the 320, 315, 320. Let's see, 315, 320. And the 265, 265, 260. Because you're only going to tie up around $500 for that kind of trade. It's not the opportune trade because you're not getting the premium like you would in high volatility type of condors. The problem with that is usually when it's high volatility and if it starts developing a new trend there, it'll remain high volatility. And you're just making condors on pullbacks on a downtrend. Condors when it ranges on a downtrend. And when that happens, you put yourself at a really massive risk to the downside. And you have to make them very short-term condors. Your condors would be like, 2 weeks at the most. A week or 2 weeks. Right now we're in the summer doldrums. The summer markets there, and it's not even the doldrums. I mean, they've been volatile as all else because of Trump. So, it could get even worse as it comes, which means there'll be a lot more premium. But I would like to see an extended range of premium and not just a spike. I'd like to see the premium at least be a little bit more extended if you're looking at the volatility of the VIX. I would like to see the more, that was taken. What is that? Yeah, that was a back ratio spread. I meant to take that and.
I guess it never got filled back in, what was that, May? Wow. That was 18, 14, 11. I wonder what happened then. In May, wow. May, April, May.
Wow, that probably would have paid off too. Oh, maybe. What was that? I'm just checking something else. That was the May 22nd. And that was short strikes are 14. So 14 short strikes. Where would I be at? May 22nd. It would have been all right. It would have paid okay. It would have gone into the short strikes. It would have been a pretty good trade because that was more of a bullish risk twist. I should have taken it, or bullish ratio. I should have taken that trade. Damn, I feel stupid. I think that was bullish. Let me double check. I'm almost sure it was. Damn it. Oh no. Yeah, man, I could have taken that trade. Damn. Man. Anyways, but it didn't get filled. That's probably why. Anyways, you see how this lower volatility, it stayed low with just a few spikes, but all in all, the range is low, and then it would spike up, and that's where you get all your premium. If I could see these lows, even though the lows are getting shorter and shorter, I like seeing that. Like this is a long right here. Then the bullish trend got a little slow, a little less and a little less here. Now it's getting a little bit lower here, whereas the bearish trend is starting to build here. So, that's what I like to see. And that means that, okay, there's a buildup of premium is more than likely on its way. Most everything I do is geometric. So, that's kind of how I look at it. On that strangle idea, again, I want to show you better than I can tell you. The strangle idea that I put in there was we were looking, and a lot of things are off right now because of the fact that when we were doing it, it was a day ago. But it just gives you kind of an idea. We were looking at the Qs. And again, our straddles, when you're doing straddles, you want that market to move and move fast. It's a thing of like, look, move fast, get into my direction, and then let me close it. That's why a lot of times a lot of guys will price out the options and earnings because there's a lot of folks that are just trying to play that earnings, so I never really do a month out, because the premium is too much, and it really is, it's one of those things where if I'm gonna do it, I'm just trying to play both sides and get lucky, but it's just one of those things I get really, really kind of skeptical of doing that far out. But here we were here and we were talking about the premium that you would get. The only it's going to change now because things are different. But basically, this is where the market is. Let's reset our price slices. Okay, this is basically this is where the markets are at. Okay, this is where our where if we bought a straddle and the market just stayed where it's at and didn't move anywhere, we would lose $12. Okay, those are our break evens right there. So these are our break even points right here, these yellow lines on each side. Be $12 to take this. Every day that this market, every single day that this market, if it stayed where it's at, didn't do anything, it would cost you $11 a day, about $11.68 a day. If the volatility increases, of course, you'll make $55 for every point that this market moves. Not every point, excuse me, all the volatility that it moves. If it goes up, for each, if it goes up each percentage, then of course, each point in that vega, each point in that volatility, you're gonna make $55. The deltas are $4. Basically, it's a little bit long on the deltas, which means you're $4 more. You're more long and a little safer. It'll take you a little longer, or you'll make more money, because it's a bullish trade. A little $4 more bullish, but that's kind of negligible. The gamma does kind of make it. It kind of amplifies it. So the gamma definitely will make that delta increase. So this is like as the market goes haywire, either way you make money. If the market falls down like from 184 to like 180, bam, you're up $44. If the market goes from 180 or 179 actually, if it goes from 184 to about 190, bam, you're up $97. And it's bullish friendly. Okay, so this is the straddle that I was looking at, but the thing is I don't like it because it's so far out, and you lose just on theta alone. Theta is your friend. Each day that this thing goes by, if you're buying something, you want it to not dissipate as much. Like when you're selling it, like a condor, you want theta to just dissipate like crazy. Like the theta on Netflix. the theta on Netflix. Oops, man, those burritos. I'm getting the itis off of my homemade burritos. Okay. So.
Oh wait, I know why. Because of volatility. Do I still have that volatility thing on? That volatility adjust? No? Okay, there we go. That's why. Alright, so each day it goes by. Right, that makes sense. Wait, nope. You should be. Oh wait, I know why, because my price slices are off. Reset slices. There we go. You make $4 a day that Netflix, every day that it just stays where it's at and doesn't do anything. Netflix just does, just stays. And, each day that this thing goes by, you're making $4. At least starting from today. And that theta, the thing is, if it moves down $1 or moves up $1, then you're gonna more than likely if it moves down $1, you're gonna be safe. Probably make $1.19. If it moves up $1, you lose $1.19, and then the gamma actually adds to that. So 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 it's a little bit more friendly on the downside. Now, if volatility goes up, you lose $5 a day, okay, or $6. So it's just one of those things that because when volatility goes down, when the price goes down, volatility likes to go up. So your theta, your delta would kind of help you out a little bit. Delta would kind of mitigate the problems of it going down. But unless it goes down precipitously, then you're screwed. Then you have to, I look at gamma as that curve, and a wide gamma smile is what I like to see. A short gamma smile, and I got to thank Matt for this. The gamma smile tells you how risky the trade is. For me, that's how I look at the gamma. The gamma smile. What is the gamma smile? This thing right here. If it's like this curve, that's a pretty steep gamma smile, which means you're going to lose a lot more if this thing starts moving around. A happy or a not as bad gamma smile is a gamma smile like that, because you're not going to lose as much as the price moves away from you. And when you're short gamma, you usually get a gamma frown. So this gamma frown is, if you look at how steep that gamma frown is, as opposed to a guy that's not frowning as much. He's not frowning as much. He's just a little discouraged. That means that if the market moves too much, you're in trouble. Whereas you got different. You've got gamma smiles, which when you're going long gamma. Okay, let me go and put the cues back up. Those are gamma smiles. Okay, gamma smiles means that if the market's moving like crazy, that's what you want. And the deeper gamma, the deeper the smile. This is what I was trying to tell you about when I was saying putting that other trade on for something that you believe is going to move fast. This guy's smiling. He's pretty happy. Look at that. I'm gonna make a jack-o'-lantern type. Look at that. This dude is so happy. That means if the market moves and it moves in your direction, he's pretty happy. He's like, man, I'm happy. That means the gamma smile, and he's laughing. He's kind of like one of those Joker smiles. Look at how happy he is. Well, what I did yesterday was I was saying, how could I get you a trade that has even a better gamma smile, but the market has to move fast and crazy, and it'll get you out quicker. Now, we were looking at the September 6th, and I want to show you the difference in the gamma smiles. Let me show you how different those smiles are. We're not going to use the September 6th because we lost a day on oh wait, let me get this. We lost a day of trading, being able to put it in, so we'll do the September 13th. If I did this and then sold a strangle,
But the strangle, and I'm gonna have to reset this how I did it yesterday. What I did is I said, okay, instead of the October, I go and I sell a strangle on top of it for say September 13th, if I could find one that's decent for the Qs. Now my deltas may be off a little bit, so it may be bullish or bearish a little bit, but the concept still stays. So if I sold a strangle, on top of that, okay. Now here's where we're gonna fix the trade up here. I want to sell the strangles outside of these of your Qs, your expected move Qs right here. I want to sell it on the expected move, so it would be the 168 201 strangle. So 168, and we could tighten it up to make the deltas neutral. I want to get it as close to delta neutral as I can. It might be a few deltas, like 4 or 5 deltas. If it's way too many, like over like 6 or 7 deltas, I'll go ahead and chill. But 168, oops, that's inversion. That would be the 201 call. This thing be inverted. That'd be assigned in 2 seconds. 201 call. And the 168 put. Well, I hope it's traded. Might not be traded. Okay. What's the closest to 168 and 201 that's being traded in September? Okay, let's see. So 170, we'll do the 170, and then instead of 201, $170,200. So let's see if that'll get us, but we're gonna have to tighten it up to make our deltas neutral. So 200 and 170. Put. Right. Okay. So, and actually I'm gonna have to even make this even better in terms of because that's way too much credit. There we go. There we go. That makes the credit was skewed. I was like, wait a minute, there's no way it'll get filled. So actually I would make this a little bit let's move this. Since we're, let's see, where are we at on this? Because, okay, our strangle, what's our deltas? So, yeah, we're 2 bullish deltas. Let's go, what if I went up? See, that's the thing, they don't have the strikes up there. That's the problem. Let me see what the strikes are at up there. We've got a 2025. Okay. Let's see what happens with a 2025. And let's go to 170.25. Let's see if even if they have strikes there. Oops. Like 2025. 169.5. So let's go down to, here we go. Okay. Let's see, 168. And let's see how far, I'm just moving this down a little bit just so I can get a little bit closer to delta neutral. 168. What else? What other strikes do we have? No.
So 169, 168. Okay, so these go down in 50-cent increments. So there's a little bit more granularity to this. So let's go 167.50. 199 is that traded. 167.50. Let's go to 167. It's 5 deltas. It's still a little scary, but okay. Yes, we got, we do have the upside is a little bit more. It's a little bit safer for us in terms of risk, but in terms of I may have moved it a little too far. So let's move that up to about 200. Let's go, and 167. Let's go to 168.5. Yeah, there we go. It's getting but the thing is, when I was talking about the gamma and the steeper your gamma smile is on when trades where you want the trade to go and bust up to the upside or bust down to the downside, you want that gamma, it's very explosive. And remember, these were our break evens. Remember, that was our break even. The market had to move all the way down there for us to be the break even originally. If we just look at our original break even, the market between now and October has to move all the way down there. Now, you're only getting 47 cents of credit, but the thing is if this is a trade where you just want to get in and get out, since your straddle is so long in the future, which, again, I normally don't do that, but since it's so long in the future, I was like, well, even though you're only getting 47 cents of credit, that means after $40 or $47, it pretty much is a wash. And that's why you saw this. After $47, like once it gets up, like what is that, 184, so that so what, 130, 184, 47 was 130, let's see, 184. And let's see, is that 47? Yeah, that's 47. So it's 231. Why did I say 130? So after 231, around, it's pretty much a wash. I'd say I'd say around 197, 197, you're pretty much, looking around, say 197 to about 200. I'd say about 200, because that's where your knees are at in terms of your, the knee of where this thing just levels off. You don't have any risk to the down or the upside. All your risk is in the center. That's if the market does not move. But remember, the basis of this was if this thing moves and moves crazy. And this is your T+0 line, which is what I trade. This line is just your expiration. I would never hold this thing toward expiration. What I'm trying to trade is I'm trying to trade the purple line, the fastness, the smile. And that's what I was looking at. If I tried to trade the smile over here, look at how, remember, this guy was smiling. Let's put a couple of smiles. He's smiling and he's like, yeah, he's laughing, saying, yeah, hey, Brotech. He's got even a little smirk, and he's smiling, and he's, doing like that, and he's like, yeah, Brotech, that's a crazy looking nose, but, that's a kind of a smile. But how happy would he be if he went from that smile to this smile? I mean, he's literally like beyond ecstatic, I mean, that smile, like, as opposed to that, you've got this smile, which is like, I mean, this is insanity. He's like Jack Nicholson, I mean, look at this smile right here. What the smile tells you is how fast you're going to get paid, profit wise, and how fast, and it moves your break even, so it doesn't have to move too far for you to make profit. Now that's a smile, okay? And that's what I was trying to explain. And here's how I explained it. Remember your break evens. Let's delete this. Remember your break evens were right here and right here. These are your break evens from your your original break evens. Now look at where your break evens are at. This is your break even right here. So that means that, that doesn't have to go as far to go ahead and get you paid. That's why you got a bigger smile. In other words, as I was showing, is per day, because of the type of trade that it is, per day, and again, it's a longer, and again, a lot of this is your commissions and how fast that market moves. If you're looking at that market to move quick and fast and in a hurry, and again, I didn't test volatility with this, as what happens if vols go up, you should be making, we'll do a test on that real quick. But without the smiles and just this trade alone, or without the smiles and just, the big smile and that trade alone, you would be making, or you lose $11 a day every day that thing sits. This thing, of course, is bullish delta, but of course it'll move. The gamma is what helps you out because that gives you your smile. So you get like $5 a gamma, and the volatility is so if it goes down in volatility a point, you lose like around 50 to 55 bucks. Now that might be balanced out with your because you should be losing on the volatility a little bit. No, actually, no, you're doing better on volatility. But you've taken your gamma down, but your deltas are phenomenal. Of course, because of the fact that your gamma, we're long gamma now because of the fact that we're more bullish on this trade than bearish, and the deltas are now bullish than bearish. Because we added that smile. If I could get these down to delta, if I can get these two things lined up, then you get a better representation. But look at how much per day. If you just held this thing per day, you're only losing $5 a day. And the Vega, your Vega before was 55. So no, it was short Vega. Wait, not that. This is the one I want. Hold on. Because we're long Vega 55, so we did cut our Vega down a little bit. So if volatility goes down and it just goes down like crazy, and of course we mitigated that with the strangle. Now of course these are not lined up, so our gamma delta ratios are going to be off because the smiles are not lined up with your expiration graph, and your like this right here. You want the belly of this to be right here at the belly of this, and that's why these are kind of off right now. The T plus 0 line and the expiration line, but even your T plus 0, if this market, each day that this market goes, this is, let's just keep going. Let's say if we went to, instead of now, we went to September 11th, you'd be down 132, and I think this is where it gets negligible. No, you're down 179 with just the strangle alone, or the straddle alone. But with this, you're only down 132. And that's if this market didn't move or if it stayed in the same place till September 11th. Now, if we go, and this is where the beauty of this is if we go August, or we say August 29th and say the market, or no, let's go the first week of September. Give us a little bit of time to see if what happens if, say September 3rd, if the market just stayed where it's at with the strangle, you'd be, with the straddle, you'd be down 46 bucks. You'd be down 76 bucks or 74 bucks. No, 76 or 74 bucks with just the straddle alone. And this kind of takes it off for you. Okay, it kind of mitigates the problem. Now, if the market does you a favor and it moves, say from 184 to about 180, and I say about 180, let's move the date back, because this helps you even with the date, and it moves down there, you're down 27 bucks. Okay, this is where, okay, now you're only down 19, so it actually helped you with the straddle. Is if it moves and there's dates ahead, but again, this is the kind of trade where I was looking at the market just moving fast and moving, like saying, hey, I just want to get in and get out. And of course, my deltas are off on this. If you're looking at it, this is bullish delta. So that's why you're not going to be making, because, if you're looking for the market to go up, you're going to make more of your money. If it goes down, you're going to lose. But once these two bellies are together and it's more delta neutral, like this is 7 deltas the way I have it. So it's not really the best to trade. I really want this to be delta neutral, and then you're going to get a better representation of if the market goes down or goes up. So of course here you're going to be losing, because the deltas are off. So you would make more money here than here because the deltas are off. This being a bullish delta trade, if it went up to 184, let's just go 190, you would be up 87. And that's, in August, you'd be up August 29th, and you'd only be up 68 with just the straddle alone. But with these two bellies together, and when I say together, when the fact that these, like, one is 5 deltas, this is 7 deltas. I'm gonna see if I can change this. I don't want to make it too far off, but let's just go to 199, 167.5, and see if we can get these deltas kind of closer. Yeah, so it definitely kind of skews it a little bit. Yeah, because I was going to try to let's see if the market's up. Let me see what happens here with just the straddle alone. 68. Okay, so we're still bullish delta bullish. I do like the smile, but if we went down to 180, that's with that. Yeah, so we're still making more on the straddle if it goes down because of the deltas, the strangled deltas. Because of where the deltas are, they're just tearing us up. The strangle. I'm gonna have to research that, but I like our bellies to be the same. But the thing is, this is one of those things where you just want it to just move fast, and get out of the way. And I look at that with the gamma smile, and as you could tell, the smile is definitely off. But that's kind of what I was looking at in terms of when I had it the other day. I had both of these at they were both, like, this was delta neutral, and this one was delta neutral too. This, what? Let's not do it. Let's pull this back, because I just straddled right there. Let me see. Let's just go 183. $2 down there. Oops. Did I go down? Wait, I went down. Let's see. 183. 186. I want to see. Yeah, so, okay, so much more neutral there. Much more neutral. And then, so, so $1 up there. $1 there, but my deltas are still kind of challenging me. Whereas I'm doing much better in that than I am the other one. I'm gonna have to research that, what I did the other day. If I went $2 down to 198, 166.5. Nah, that's not what I'm looking for. It's closer, but it's not exactly. I mean, I'm down to the almost delta neutral, but I had both bellies. I had a lot better on the upside the other day when we were talking about it. It was much better on the upside than the downside. So right now, and a lot of it is the skew, market skew. Yeah. Oops, it's not traded. 198. Let's see, 198, 166.5. Oh wait, I know why. It's not traded. I'm sorry. So 166. Yeah, my deltas are still. I mean, the other day it was delta neutral. Right now it's definitely the strangle is way off delta wise. But the fact that I had that gave me the opportunity both on the up and the downside. Yeah, because the profit is definitely skewed. Let me reset. Anyways, that's what I was looking at. And let's go back to the 201, 168, 201. Oh, yeah, it's not being traded. So 168, 200. Yeah, 167, 200. Okay. But yeah, the way I had it is, I mean, it was perfectly balanced, and I'll just have to redo, these were perfectly balanced, and it was right now the deltas are very, very off. Let me see where my straddle deltas are. Oh, wait a minute, I just did something. Reset slices. Okay. Okay. That's why I'm off. Okay, makes sense. I was off. Scratch that. My price slices were off. They were still stuck. I'm stuck on stupid. Yeah. So if this market went down to 180, no, I was right. Okay, went down to 180. Then with the straddle alone, I'd be up 84. I'd only be up 33 with the strangle in there, and that's because of this being bullish deltas. Okay, no, never. Don't scratch that. So if I was up here. Mine's a shot, so and it went up to 190. Without that, I'd be 59, and then 71. Yeah, that makes sense. But the thing is I just like the smile. The smile is much, which means that the market will move a lot faster. And I do have some safety on the upside. I could push this, the other one to try to get it more delta neutral, but the way I had it yesterday, before when we were talking, it was phenomenal because it was a complete delta neutral straddle and a complete delta neutral strangle, but they had different dates, and just the way that it was, it just made it took a lot of the pain. Let me see if I can even pull this out a little bit. Let's see. I'm just seeing something. And then if I went down, nah, I don't want to do that because it's not traded. So if that's there, and I bring this up just a hair bit, yeah, see that's, okay. I'm just seeing if I bring this up, and just what it does to my straddle. Oh, let's reset the slices. Yeah, see. No, it's not helping. No, it's not helping. I was just seeing where the deltas were at and how that would, let's see. Yeah, no, I'd be getting hurt with the strangle on. I'm just seeing how bad it'd be getting hurt with the strangle on. Okay, that's 559, and then you're really down, so that'd be a little better right there. Let's see on the upside. So actually, it's a little better. I was just looking to see if I could tighten up and make the smiles a little better. So let's see, 127, 102. Actually, I think we got a solution here. Huh. I mean, but man, I had it yesterday. It was delta neutral and it worked out great. Okay, so let's reset the slices. That was, it's probably just me. Okay, so day-to-day profit, if the market just stayed there with, if the market just stayed there and didn't move, I just moved my my puts up a little bit so I could have a little more even. But if the market just stayed there and didn't move, then you're down $11. If it stayed there, didn't move with the straddle, you're only down $5. If the market moves down, this is why I like the gamma, because that's, we're just really taking advantage of that gamma. But this is one of those trades you don't want to hold on. You just want to see the market move and move if you're very straddle happy, and you want so this one, if it moved down, you'd be up $100, and so no, this is definitely, the deltas would definitely hurt you in this, because then you would only be up $4 right there. And let's see what you'll be up here. I'm just arbitrarily moving it. Okay, 106 without that, and then 197. So yeah, this is more bullish. Definitely a more bullish upside than there is to the downside. You could tell by look at how the smile is not as smiling and as deep as this smile right here. But the other day, the smiles, when I did this, the smiles were almost exact. Like this was a really deep smile right here, and it would have looked something like this. And what it was is that it was totally neutral, and you make more money because of the smile and how fast this thing was moving. So the theta was like, of course, with the strangle on, all things being equal, with the strangle on, all things being equal, we were cutting off $3 a day on your trade in theta. Literally cutting it by a third. Yeah, we were literally cutting that by a third. We were with that, of course. Now with that and the way I changed it, we're losing $4 a day as opposed to 11. But we were down. Actually, we're losing less than the first time I put it on. But it was just something I noticed. The deltas was killing us because of the bullishness of the delta. And that's the only thing. But when I had them both delta neutral, and they were both almost perfectly aligned yesterday, and it's possibly because of the Vega that came up. Today it's Vega because the market got a little more volatile, and our Vega is we're with before we had 58 Vega, but of course we just you're going to take off damn near 20% of your Vega. With the straddle, with the strangle on, of course, because it is a negative Vega trade. I mean that's what so you're taking off some of that, but I was just doing that, and I was like, hey, if you want to get paid fast and not have to wait, and you'll get paid more faster, then the way this is the smile was up, so if it moved just a little bit, you're getting paid faster and more than if you had just this alone, where it would have to travel and travel and travel, and then you start looking at getting paid. Plus your break evens, they were right here originally. I had moved your break evens in. Originally, your break evens, and I had actually moved where your break evens were, so it doesn't have to move a lot further to go to break even, and then you're just making more money. So you had, so you have a lot better chance of getting paid quicker. Should something like just skyrocket way to one side or the other. But hopefully that helps.